Are you preparing for the NMLS SAFE mortgage loan exam and looking for an effective way to master key concepts? In this video, we'll dive into the top 200 NMLS mortgage loan exam flashcards to help you confidently tackle the test. From federal mortgage laws to ethical practices, these flashcards cover everything you need to know. Let's get started. Loan application. In simple terms, it is the form you fill out to ask for a mortgage. As per textbook definition, loan application is a document submitted by a borrower to apply for a loan.
Loan closing. In simple terms, it is the last step where you sign all the papers and get your loan money. As per textbook definition, loan closing is the final stage of the mortgage process where documents are signed and the loan is funded.
Loan commitment. In simple terms, it is a lender's official promise to give you a mortgage under certain conditions. As per textbook definition, loan commitment is a lender's promise to offer a loan or credit extension up to a specified amount for a specified time, under certain conditions.
Loan estimate. In simple terms, it is a clear breakdown of your loan costs and terms given by the lender before you agree to the mortgage. As per textbook definition, loan estimate is a standardized form that provides detailed information about the costs and terms of a mortgage loan, required under TRID.
Loan estimate tolerance. In simple terms, it is how much your final loan costs can differ from what the lender initially estimated. As per textbook definition, loan estimate tolerance is the maximum amount by which the actual costs at closing can exceed the estimated costs provided in the loan estimate.
Loan modification. In simple terms, it is changing the terms of your current loan to make it easier to pay. As per textbook definition, loan modification is a change made to the terms of an existing loan by a lender, often to help a borrower avoid default.
Loan officer. In simple terms, it is someone who helps you get a mortgage. As per textbook definition, loan officer is a professional who assists borrowers in obtaining mortgages.
Loan officer compensation. In simple terms, it is how mortgage salespeople get paid, with rules to make sure it's fair to borrowers. As per textbook definition, loan officer compensation is the way loan officers are paid for their services, subject to specific regulations to protect consumers.
Loan origination. In simple terms, it is the steps involved in getting a new mortgage from start to finish. As per textbook definition, loan origination is the process of creating a new mortgage, from application through approval and funding.
Loan origination fee. In simple terms, it is a fee you pay the lender for setting up your mortgage. As per textbook definition, loan origination fee is a fee charged by lenders for processing a new loan application.
Loan origination system, LOS. In simple terms, it is a computer system that helps manage the entire mortgage process. As per textbook definition, loan origination system, LOS, is a software platform that automates and manages the end-to-end loan production process from lead to closing.
Loan originator. In simple terms, it is someone who helps you apply for a mortgage or negotiate its terms. As per textbook definition, loan originator is an individual or entity that for compensation or gain takes a residential mortgage loan application or offers or negotiates terms of a residential mortgage loan.
Loan processing. In simple terms, it is getting your loan application and paperwork ready for the lender to review. As per textbook definition, loan processing is the preparation and compilation of a borrower's loan application and supporting documents for underwriting review.
Loan product advisor. In simple terms, it is Freddie Mac's computer program that helps decide if a loan meets their standards. As per textbook definition, Loan Product Advisor is Freddie Mac's automated underwriting system used to evaluate borrower creditworthiness and overall loan quality.
Loan servicer. In simple terms, it is the company that manages your mortgage after you get it, collecting payments and handling questions. As per textbook definition, loan servicer is a company that handles loan accounts, processes payments, responds to borrower inquiries, and manages other administrative tasks related to a mortgage.
Loan servicing. In simple terms, it is managing your loan after you get it, including collecting payments. As per textbook definition, loan servicing is the process of collecting payments, managing escrow accounts, and handling administrative tasks related to a mortgage after it's originated.
Loan-to-cost ratio. In simple terms, it is how much you're borrowing compared to the total cost of a commercial property project. As per textbook definition, loan-to-cost ratio is a metric used in commercial real estate lending that compares the amount of the loan to the cost of the project.
Loan-to-value (LTV) ratio. In simple terms, it is the amount of your loan compared to the value of your home, shown as a percentage. As per textbook definition, loan-to-value (LTV) ratio is the ratio of a loan amount to the value of the property.
Loan-to-value ratio, LTV. In simple terms, it is how much you're borrowing compared to how much the home is worth, shown as a percentage. As per textbook definition, loan-to-value ratio, LTV, is the ratio of the loan amount to the appraised value or purchase price of the property, expressed as a percentage.
Lock-in agreement. In simple terms, it is a promise from the lender to hold a certain interest rate for you for a set time. As per textbook definition, lock-in agreement is a written agreement from the lender guaranteeing a specified interest rate for a specified period of time.
LTV. In simple terms, it is the amount of your loan compared to the value of your home, shown as a percentage. As per textbook definition, LTV is loan-to-value ratio is the percentage of a property's appraised value or purchase price that a lender is willing to finance through a mortgage loan, used to assess lending risk.
Manual underwriting. In simple terms, it is when a person, not a computer, reviews your loan application in detail. As per textbook definition, manual underwriting is the process of evaluating a loan application without the use of an automated underwriting system, typically for complex cases.
Margin. In simple terms, it is the extra percentage added to a base rate to set your adjustable interest rate. As per textbook definition, margin is the fixed percentage added to an index rate to determine the total interest rate on an adjustable rate mortgage.
Market value. In simple terms, it is the amount your home would sell for today. As per textbook definition, market value is the price at which a property would sell in the current market.
Mortgage broker. In simple terms, it is someone who helps you find a lender for your mortgage, but doesn't actually lend the money. As per textbook definition, mortgage broker is an intermediary who brings borrowers and lenders together, but does not use their own funds to originate mortgages.
Mortgage credit certificate. In simple terms, it is a document that lets you claim some of your mortgage interest as a tax credit. As per textbook definition, mortgage credit certificate is a certificate issued by certain state or local governments that allows a taxpayer to claim a tax credit for some portion of the mortgage interest paid.
Mortgage insurance. In simple terms, it is extra insurance you pay to protect the lender if you can't pay your mortgage. As per textbook definition, Mortgage insurance is insurance that protects lenders against losses if a borrower defaults on a mortgage.
Mortgage insurance premium. In simple terms, it is extra insurance you pay on FHA loans to protect the lender. As per textbook definition, mortgage insurance premium is a monthly payment made by borrowers to insure the lender against default on FHA loans.
Mortgage note. In simple terms, it is the agreement that explains how much you borrowed and how you'll repay it over time. As per textbook definition, mortgage note is a legal document outlining the terms of a mortgage loan, including repayment schedule and interest rate, serves as evidence of debt obligation.
Mortgage-backed securities. In simple terms, it is investments made up of many mortgages bundled together. As per textbook definition, mortgage-backed securities is investment products created by pooling mortgages and selling portions of their income stream to investors.
Mortgage-backed securities, MBS. In simple terms, it is investments made up of many mortgages bundled together. As per textbook definition, mortgage-backed securities, MBS, is investment products created by pooling mortgages and selling portions of their income stream to investors.
Multiple listing service, MLS. In simple terms, it is a system that lists homes for sale by real estate agents. As per textbook definition, multiple listing service, MLS, is a database of properties for sale by real estate agents.
Negative amortization. In simple terms, it is when your payments don't cover all the interest, so the amount you owe grows. As per textbook definition, negative amortization is a situation where loan payments are insufficient to cover the interest due, leading to an increase in the principal balance.
Net worth. In simple terms, it is the total value of what you own minus what you owe. As per textbook definition, net worth is the total value of an individual's assets minus liabilities.
Non-conforming loan. In simple terms, it is a mortgage that's too big to be bought by major government-backed agencies. As per textbook definition, non-conforming loan is a loan that exceeds the dollar amount loan limit imposed by Fannie Mae and Freddie Mac, such as a jumbo loan.
Non-occupant co-borrower. In simple terms, it is someone who helps you qualify for a mortgage but won't live in the home. As per textbook definition, non-occupant co-borrower is an individual who is co-signing a mortgage without intending to live in the property.
Non-qualified mortgage. In simple terms, it is a flexible loan option for borrowers who don't meet strict requirements for qualified mortgages. As per textbook definition, non-qualified mortgage is a type of home loan that does not meet qualified mortgage standards, but may still be offered based on alternative lending criteria.
Note. In simple terms, it is the paper you sign promising to repay your mortgage. As per textbook definition, note is a legal document that obligates a borrower to repay a mortgage loan at a stated interest rate during a specified period.
Note rate. In simple terms, it is the interest rate written on your mortgage agreement. As per textbook definition, note rate is the interest rate stated on a mortgage note.
Origination date. In simple terms, it is the day your loan is finalized and the money is given to you. As per textbook definition, origination date is the date when a loan is created and funds are dispersed.
Origination fee. In simple terms, it is a fee you pay the lender for setting up your mortgage. As per textbook definition, origination fee is a fee charged by a lender for processing a new loan application, typically a percentage of the loan amount, covering the costs of underwriting and preparing loan documents.
Partial payment, in simple terms, it is paying less than the full amount owed on your loan. As per textbook definition, partial payment is a payment that is less than the full amount due on a loan.
Piggyback loan. In simple terms, it is taking out two loans at once to avoid extra insurance costs on your main mortgage. As per textbook definition, piggyback loan is a second mortgage or home equity loan taken out simultaneously with the main mortgage, often used to avoid paying PMI.
PITI, in simple terms, it is the total monthly cost of your mortgage, including loan repayment, taxes, and insurance. As per textbook definition, PITI is principal, interest, taxes, and insurance are the four components of a monthly mortgage payment.
PMI. In simple terms, it is extra insurance you pay if your down payment is less than 20%, protecting the lender if you can't pay your mortgage. As per textbook definition, PMI is private mortgage insurance is a type of insurance that protects the lender if a borrower defaults on a conventional loan with a down payment of less than 20% of the home's value.
Points, in simple terms, it is upfront fees you can pay to lower your interest rate. As per textbook definition, points is fees paid directly to the lender at closing in exchange for a reduced interest rate, with 1 point equal to 1% of the loan amount.
Pre-approval. In simple terms, it is a letter from a lender saying how much they might lend you. As per textbook definition, pre-approval is a letter issued by a lender indicating the loan amount for which the borrower is eligible.
Prepayment penalty. In simple terms, it is a fee some lenders charge if you pay off your loan early. As per textbook definition, prepayment penalty is a fee that some lenders charge if a borrower pays off a loan earlier than the agreed-upon term, designed to compensate the lender for lost interest income.
Principal. In simple terms, it is the actual amount you borrowed, not including interest. As per textbook definition, principal is the original amount of a loan, excluding interest.
Private mortgage insurance, PMI. In simple terms, it is extra insurance you pay if your down payment is less than 20%, protecting the lender if you can't pay your mortgage. As per textbook definition, private mortgage insurance, PMI, is insurance that protects lenders against losses if a borrower defaults on a conventional loan with a down payment of less than 20%.
Property tax. In simple terms, it is a tax you pay on your home to local authorities. As per textbook definition, property tax is a tax levied on real estate by local governments.